Hi, I'm Amberly Mason, and in this edition of the 3-Minute Trading Expert, I'm going to cover how to spot overbought and oversold conditions. If you can recognize these conditions, you can use them to make a lot of successful short-term trades. When traders say an asset is overbought, it means that the asset has enjoyed a prolonged period of rising prices. And since no asset runs higher and higher in a straight line, overbought markets tend to suffer sharp sell-offs. Conversely, when traders say an asset is oversold, it means the asset has suffered a prolonged period of falling prices. And since no asset runs lower and lower in a straight line, oversold markets tend to experience sharp spikes higher. Both instances are basically extreme situations becoming less extreme. Mother Nature likes to correct extremes in both directions. Statisticians call this correction reversion to the mean. There are many ways to measure overbought and oversold conditions in a market. One of the simplest and most useful methods of measuring these conditions is with an indicator called the Bullish percent index. The Bullish percent index measures overbought and oversold conditions with a reading between 0 and 100. Knowing the fine details of how these readings are computed isn't important for this video. It's more important to know that high readings above 80 indicate a market is badly overbought and due for a correction. Low readings below 30 indicate a market is badly oversold and due for a rally. Think of it like a rubber band being stretched to its limit and then snapping back in the opposite direction. The most common bullish percent indexes measure specific stock sectors like gold mining, banking, and energy. Stock sectors fluctuate between states of overbought, neutral, and oversold. Our colleague Jeff Clark, editor of the S&A Short Report, has proved over the years that sector fluctuations can be profitably traded with the bullish percent index. For a quick example of how one of these overbought, oversold trades work, see this chart of the bullish percent index for the gold stock sector. It covers the period of mid-2011 to mid-2012. Note how the gold stock sector was extremely oversold in July 2012. This extremely oversold reading appeared after the gold stock sector fell 15% in just over a month. Remember, a 15% decline in a year is a big move for most sectors. Around the time the gold sector registered this extremely oversold reading, Jeff Clark recommended several trades in the gold sector. As Jeff expected, gold stocks staged a big snapback rally and gained more than 30% in just under 2 months. It was a huge rally from the oversold state. Because he used options to leverage the trade, Jeff guided his readers to triple-digit percentage gains. Just like any trading strategy, betting against overbought and oversold conditions isn't perfect. Extreme conditions can persist for quite a while, so you'll have to use measures to limit losses when a trade goes against you. But remember, Mother Nature likes things to revert from extreme conditions to less extreme conditions, and her work shows up in the stock market. If you know how to spot these conditions, you can use them to make low-risk, high-reward trades. I'm Amberly Mason. Thanks for watching, and good trading. If you want to learn another incredibly powerful trading secret, click here to watch the next video.